Hey, good day. I am Floral Sigatapang from BSBFM Section 3. I'm here to discuss to you the impact of coronavirus to our mutual funds or investments and to our economy. First is what happens to our mutual funds or investments during this crisis. COVID-19 and the mutual fund industry. An industry under pressure, tighter margins, more considerations, and a changing workplace. COVID-19 and its economics and social disruption have given new urgency to the challenges facing mutual funds. Last year, in our publication, Mutual Funds Outlook, the time to act is now. We highlighted trends we expect to see from 2019 to 2025, such as slower growth and shrinking fees. These trends have all accelerated, and mutual fund managers need to move even faster to maintain and improve their positions. With the pandemic in mind, you may now be rethinking your forecast and expectation for the near and mid-term future. But this is not just about playing defense. These are steps you can take now to help you prosper over the next 5 years. Organic growth in the U.S. mutual fund industry has continued to slow. Despite upside surprises in the overall market, the long-term outlook is under stress too from downward pressures on fees, reduced profit margins, and changing investor preferences. Adding a pandemic to the list depends the challenge for asset managers to remain competitive. Active fund managers are widely believed to outperform during market downturns. This column uses daily returns from U.S. active equity mutual funds to examine fund performance and investor behavior in the midst of the COVID-19 crisis. It finds that active equity mutual funds underperform a variety of passive benchmarks, contradicting the popular belief that active managers outperform in downturns. In addition, investors have favored sustainable funds during the crisis, suggesting that sustainability is now viewed as a necessity rather than a luxury good. The second one is, what is the impact of coronavirus crisis on the money market funds or investments? As global economic growth declines in 2020, organizations are being forced to make difficult decisions about cost and spending. In this environment, the effects on innovation investment remain unknown. Will companies pull back, anticipating further financial losses or challenges in generating revenue, or will view robust innovation spending as a critical piece of their plans for recovery and questions? To answer this question, it is helpful to look at the last several years and at the period immediately following the financial crisis of 2008 and 2009 period. The Global Innovation Index or GII 2020, released in September 2020 and co-published by the World Intellectual Property Organization, Cornell University, and INSEAD, analyzes key global innovation trends and presents a ranking of the innovation performance of more than 130 economies around the world. This is the 13th year of the report, which launched in 2007, computed amid the coronavirus crisis and thus don't capture the full impact of the pandemic. We can use the findings from the GII body of work compiled over the last decade to form an outlook on the short and medium term. Since 2009, average innovation expenditure worldwide have been growing faster than GDP. According to GII estimates, in 2017 and in 2018, global R&D grew by 5.0% and 5.2% respectively, in line with the strong growth of the period before the 2008 financial crisis and significantly stronger than global GDP growth during that same period. The growth in R&D expenditures since 2009 was sustained by investment made by key emerging markets such as China and India. We see this reflected in the GII 2020 findings. China's R&D investment grew 8.6% in 2018. India's R&D spending growth in 2018 is estimated at 5.5%. Spending by high-income economies also contributed to strong global growth. R&D expenditure in 2018 increased 8.3% in the Republic of Korea, 3.4% in the US, and 3.7% in Germany, and also 2.4% in Japan. Private sector funding drove much of this growth during the last decade. The top spending 2,500 R&D companies invested $972 by 8.9% over the previous year. R&D spending among this group is responsible for 90% of the world's business funded R&D, and the top 100 R&D spending companies account for more than 50% of all corporate global R&D expenditures. For most of these top R&D corporations, this R&D corporation innovation is now a vital component of their business strategy in an internationally competitive environment. Global intellectual property or IP filing activity also has been growing at a steady pace since 2009, setting new records in 2018 and 2019. Worldwide, patent filings grows by 5.2% in 2018. Strong growth was also experienced in trademarks, industrial designs, and other forms of IP. Moreover, venture capital or VC and other sources of innovation financing was an all-time high prior to the pandemic. Historically, business R&D expenditure, IP filings, and venture capital have moved parallel with GDP, slowing markedly during the economic downturns such as in the early 1990s and early 2000s. Yet, following the 2008 and 2009 financial crisis, GII analysis found that a number of economies never experienced aggregate R&D, including Argentina, India, Republic of Korea, Mexico, Poland, and Turkey. For another economies including the Brazil, Chile, Germany, Israel, the UK, the US, Singapore, South Africa, and the poll was short-lived. The third one is lesson and tips on investing when the markets are volatile. Investors should know what market correction is, what happens during the same, and how can they prevent hysteria during such turbulent times without timing the market or taking reckless decisions. This is important as it helps the investor to make suitable choices without looking losses and also achieve their financial goals. This is the 5 tips to handle market volatility. First is know the why. Are investors sure of what market correction means? Why is there chaos amongst investors or suspension among potential investors? One reason could be that market correction is closely associated with the market volatility, wherein markets are considered to falling steep. However, Market volatility usually means the interruption in the upward market movement which is caused by temporary price correction. This certainly does not mean the markets will not rise again. It takes some time for the markets to bounce back. Usually, market correction happen when the prices of equity keep falling and investors end up panic selling. This is often propelled by geographical or political turmoil or any natural or man-made catastrophe, relevant or irrelevant. The second tip is manic markets, don't panic. So as mentioned in the previous point, manic markets often persuade the investor to redeem. One needs to realize that market correction is a temporary phase or will soon pass out. Markets are akin to car diagram or life, has its ups and downs, but with the springs backs. If one closely analyzes the market trends, there have been an ascending movement on the market. For instance, from October 13, 2010 to December 2011, the 50 index has seen price correction of 27%. However, the index bounced back from the bottom of December 2011 to March 3, 2015 by 98%. Data as on October 2016. The third tips is be precise, follow advice. If you are still unable to convince yourself, then you must definitely consult a financial advisor. This is because they have the experience or brilliance to help you in not only making correct investments decision, but also in help resisting your temptation to redeem during a market correction. This counseling plays a strong role in your journey to create wealth without worrying about volatility in the market. The fourth tip is focus on the forest, not on the tree. Coming back to your initial reason to invest mutual funds was to achieve your financial goals. However, your forwarding towards the market volatility is making you forget about your goals while it is tempting you to redeem your investment. This is a situation where investors conjure an image of the calamity in the market, which steadily takes an image of calamity control over the minds, pushing the financial goal towards to end their list of priority. It is a paramount for investors to be firm about their financial goals and hold to their investment till they realize the same. If one stock or fund is underperforming, that does not mean you fail over or discard it. Obviously, your reason to invest in it was because of certain goals you aim to score, and hence deviating from it won't help you at all. The last tip is don't catch your chickens before they hatch. Now, a common practice among investors is that if they have invested in a bull market, they assume the situation to remain the same throughout, not thinking much about the bear market. Since market movements are cyclic, investors should have a realistic plan in mind while investing. Be prepared for all kinds of market movements. This is precisely why investors are often suggested to not put all their eggs in one basket and follow a diversified pattern of investing. This is also helps in potentially reducing the overall risk, avoids investors to be hysterical during a market correction.